All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Interesting action in the market here this morning. Very interesting. Ultimately on some pretty low volume, but market reacting here to the jobs report, and we're seeing a little bit of rotation here. But let's go out and do what we have to do here for the challenge, and then we'll go look at it. Bank of America is hitting its time stop this morning, 7:05 a.m., and it's trading below where we got out of that original position at there. So yes, it's green from the original entry, but we are talking about the option on there being red from the secondary adjustment. So time to back on out here of Bank of America and say goodbye. So let's come in here and do that with the 12 contracts, and let's see here if they'll give me a decent price on them. 195, I'll try. Yeah, they filled me at 195 there, no problem. So stock's probably going up from here. But anyway, out of Bank of America at $1.95. This is one where we entered for 137. We closed out 40% of it at 228. Held the other 60% and closing it here at 198. So we are out there. Let me make sure the alert goes out. Sorry about the pause there. Just double checking everything. All right. So there we are. Bank of America is closed, 7:05 a.m., 195. The exit price there on that. And, we end up grabbing, 1,300, 1,400 from the trade. So, nothing too great, but nothing too terrible there. We didn't have a lot of torque on that with the way the option was. We went up, we hit our first strike, and then just kind of our first price target, and then just kind of died, there with the position. So, out of it there with the time stop. Now we have Disney. Which is down a little bit here this morning. It did go ex-dividend, so we have to make a few adjustments here. But the option price, $560, is where it's sitting, so not a whole lot of change there. And you'll see it hits its time stop at the close here today. But the option is green, so we would not be pulling it if it were to close right here. Would be holding it here to the auto exit date for the green, or if at any time the option dips red and I jump on video at one of our normal times, then we'd be pulling it. So no change there. And then Under Armour, no change there. Stock is down? It's down 18 cents now. So it's been pulling back here just a little bit. Let me get these prices in for Disney. Yeah, $560. And then for Under Armour, let's get the price in there. $2 there on Under Armour. So down, $200 on that here this morning. Nowhere close to stop, nowhere close to the time stop, so nowhere close to the profit target either. So nothing to adjust, nothing to really do there. With that, Disney, let's come in here. The stock went ex-dividend today, so it's one where, if we pull it up on stock charts, something like Disney, right now is showing down $1.38. But it's really not down to $1.38. 88 cents of that is from its dividend, and that doesn't affect the option value. The dividend's already priced in. Everybody knows it's coming, so it is priced into the option value there. It's a Dago X dividend here today, and let me get the exact number. I thought it was 88 cents, but I'm just double checking here. Yeah, 88 cents. So we'll come in here and we'll just adjust everything down on Disney down 88 cents. So the entry price is 141.04, minus 88 cents. And let's come in here, and I'll turn that into an equation. There we go. So that takes our stock entry price down, right? Our ATR is not affected. Our stock exit level is, so minus 0.88, right? We'll take that down. And then minus 0.88 on the profit target there. And so now we're in line with what everything should be here on on Disney. The current stock price probably isn't in line. It's probably it's doing what Stock Charts is doing. It's not adjusting for the dividend yet, but it will by Monday. So I'm not going to adjust that there. So anyway, that's how we sit. We're just kind of grinding along. Really just grinding along. We haven't really seen a whole lot of torque or trend in a lot of these names. The market has drifted on higher, but a lot of the trend in the market has been, with utilities and snapbacks in some other areas that really just aren't on the watch list. So, we're plugging along what we have. 7,500 in trades here, so it does leave us enough for enough cash for another position should a trigger arise. About 3,000 here in cash. Now we do not have another trigger here this morning. We have a bunch of downside crossovers happening out there. Twilio, which had an upside crossover on it the other day, on Wednesday. It has a downside crossover on it here today, but it's not triggering bearish. In fact, the bull signal is still intact on that. Pepsi has a downside crossover here. We are seeing money kind of get rushed out of utilities, consumer staples here today on the jobs report. We have gold crossing on down. I was told last week that, fund managers are chasing into gold. I guess they're getting hit here today. But, keep in mind, gold is not a fund manager entry exit. Gold is driven by central banks, ultimately. And, some of the retail buying, does affect it. But, we are seeing, some of this pullback come in. Again, where I want to see it. I want to see it down in the retracements. We didn't see it trigger bullish on the 3-7 crossover up. It's not triggering bearish on the 3-7 crossover down. We have Triple M, which is given a 3-7 crossover down. I thought, this might be something that triggers, but it is not. It is not triggering here. Is it because it's a little too high in its recent range? Perhaps, but the consolidation number is just really high here for Triple M. Okay. All right. So, that's it. Selling Bank of America, holding Under Armour, holding Disney here. No real change in those. In terms of the trade, they're down a little bit here, but nothing there to react to. Now, Under Armour, there are two signals, or there are two tickers for Under Armour. You see UA, which is trading at 22.51, and you see UAA, which is trading at 25.73, and they are different. Right? UAA is what they call a Class C share. UA is a Class A share. What's the difference? UA gives voting rights, right? You have voting rights there for decisions made by the company when it goes to shareholder votes. UAA does not have shareholder rights, so you don't have any say there. Now, I don't really care about that from a trading standpoint. Right? I could care less. Right? Which one do I want? I want the one with liquidity. Because they're both going to move in the same direction. Yeah, the prices are slightly different, so percentages may change a little bit from day to day. But we're talking about something where I'm looking at it from a trade. So what do I want? I don't care about voting rights. I want liquidity. Right? Look at the shares per day here on Under Armour. Right? We're up around 4 million average per day on the UAA shares. On the UA shares, we're about 2 million a day. So the UAA has about double the volume that UA has on a daily basis, and that also comes into the options. So if we come into UAA and we look at just some open interest, I'm just going to come into the July. You can see some of the open interest on here. I mean, 6,000, 7,000 here on the 25 contracts. So a little bit of open interest there. If we come into UA, you'll see the open interest across the board is simply lower, right? There's just not as much open interest, so the spreads tend to be higher. So UA just is not as tradable of an entity as UAA. So that's why I go with UAA rather than UA, right? We see the same thing with Google, right? You have Google, GOOG, and then you have GOOGL, right? We have Class A, we have Class C. Most people trade Google L, right? And, about 2 million volume a day. Google has about 1 million volume a day, or GOOG has about 1 million volume a day. It's not that one's the right one to trade or one's the wrong one to trade. Both of them, do the job. It's just, for me, a liquidity issue. And, if I get the liquidity, then, that's what I want. I want the one with the higher liquidity, and so that's what I went with there with Under Armour UAA. That's why UAA is on the watch list and not UA there for it. Okay. So anyway, that's a good distinction there, or a good way to kind of gauge which one to trade. Trade the one with the most volume, because unless you're an investor for the ultra long term and are buying gobs of shares and want voting rights, the Class A, whoop-de-doo. There with that, from a trader perspective, there. Okay. All right. Now this morning we saw something really interesting in the market, right? And whenever we come up to events, you hear me say the same thing ahead of the event. It's one thing to predict what's going to happen in the event, what the numbers are going to be. It's a whole different thing to gauge the market reaction. I wrote facetiously this morning that the bears finally got what they wanted. They finally got some positive economic data, right? I mean, we've been dealing with some economic data that's been eroding, just simply eroding here this week. And then we get the jobs report, and what do we get? Oh, well, we get a better than expected number. Right? Last month was revised down just slightly, but the number was supposed to be 165 this month. It came in at 224. I mean, that's a, 59K difference? That's a pretty big jump, right? The unemployment level rose to 3.7, but, that's not that big a deal there. No one's really watching that closely. 191 on the private payrolls. We saw manufacturing increase by more, participation rate increase. The average hourly earnings missed just a little bit, but, still in a decent spot there with it. So, we get a better than expected number. And then what do we see happen? Well, we see bonds make a move, right? We see a ZN. Here are bonds. Bonds make a move, and bonds move on lower. What's happening to interest rates? Interest rates are going up, right? The market's having to do something. The market is having to price out some of the probability of a Fed rate hike or a rate cut, right? That's what they're doing here with this. They're saying, well, the Fed likes to look at jobs. Maybe the Fed doesn't cut, 50 basis points. Maybe they don't even bother cutting 25 basis points because of this number. Rational? Probably a little irrational, right? Probably a little irrational. Fed doesn't pin things on one number, but the market is, saying, look, that's what we're worried about. And so some of the big gainers of late, right? Some of the big gainers, the consumer staples sector, the XLP, getting hammered today, right? Utility sector, XLU, getting hit hard. GLD getting hit hard. UUP rising, the U.S. dollar on the rise. And so we're just seeing this kind of, rotational effect, really take hold here. Now, that's what we saw right on the open. But since then, we have seen most other things just start to bleed, right? Just start to bleed lower, start to bleed on down. But you think about higher rates. Think about the home builders, right? I know the home builders, got a little jump in them at the end of last week, after KB Homes, much better than Lennar earnings. But, you think about the home builders, rising rates, not in this environment. If the Fed is not going to cut rates, then, these home builders, they don't have a prayer. They will fall very sharply. And so we're seeing them drop rather sharply here today. That's the kind of the rotation we're seeing. Money coming out of some of the areas that it has been going into and catalyzed by a better than expected jobs report. So, the whole kind of theory on the market of, hey, buy everything that, is going to be benefited by a lower dollar and lower interest rates. That's getting unwound a little bit here this morning. Right? Does it mean that's going to be permanent? No, it doesn't. Right? In fact, if we look at the market this morning, we look at the S&P, we're not talking about massive volumes, right? The volumes here in the market are rather subdued, rather light. I mean, we had 1 minute over 10K, and that was the first minute here this morning. We've had a few minutes over 5K, a few over 4K, but most are in this 3K area, which is relatively light. And you say, well, does that mean that, the market doesn't believe in this move or anything else like that? No, it simply means, look, we're dealing with a holiday time, right? That's what we're dealing with. And so the reactions, are going to be a little bit lighter in terms of volume. But we're seeing a pretty hefty unwind here when it comes to, some of the rate hike hopes or rate cut hopes. And we're seeing, the performance of various sectors reflect that. Right? If we come into a sector summary here this morning, financials are leading the way. They've now turned red, but they're leading the way, right? Who's lagging? Real estate, who benefited by benefits by a rate cut. Industrials are getting hit with the rising dollar along with materials. This has shifted just a little bit. It was consumer staples and utilities on the bottom, and tech has started to erode here as well to kind of make this a mass sell. But we still see, even an hour later, we still see the kind of, the rate effect coming into play. So better than expected economic data leading to the selling here in the market. And let's face it, we have Iranian tensions escalating here this week. That hasn't driven the markets down. We have the trade war stuff. We have more tariffs levied on Vietnam. That didn't drive the markets down, right? But a better than expected jobs report, that's going to take the market here, right? And look, I mean, if you were to say on Wednesday, look, the jobs report's going to be much better than expected, and the market's going to sell off 1%, you'd probably be put into a mental institution, right? As far as the logic behind that. Right, but it's just one of the elements of the market that is consistent, right? We can get the reactions, right? And I heard several people say, "Oh man, on Monday, man, we got the truce between U.S. and China. I would have expected the markets to just keep jumping and popping on Monday." Well, they didn't, right? They absolutely didn't. We had a safety rally on Wednesday. And today we're pulling back, almost 8% here on a better than expected jobs report. Welcome to the markets. It's one of the reasons why you don't see me get caught too much, get caught up too much in the speculating of what data is going to look like and what data is going to be. And it's more about reacting to it and saying, okay, you know what, is this game changing? Is this going to drive things one way or the other, for a longer period of time? And, what do we see historically from a jobs report? We see historically that a jobs report does not become the driver for the market. Yes, it creates a reaction on that day, and a lot of times, we can see it start lower, reverse higher, or start higher, reverse lower. But it doesn't tend to be the trend signal here for the markets, right? It will be very interesting, and to hear what the Fed has to say about all this as we get into next week. Let me pull it up here. Let me go back. Let's get where the Fed governor schedules here in the U.S. announcements. But next week, on Monday, we have Richard Clarida speaking. But then John Williams here on Tuesday will be speaking this is this week. That doesn't look right. Let's get to next week. Here we go. Yeah, this looks better. Bullard here on Tuesday is speaking. Quarles, who, is not listened to as much, will speak a little bit later. But Bullard on Tuesday and Wednesday here next week. But the biggest thing is we have the Fed chair speaking on Tuesday and Wednesday, and this is in front of the House and front of the Senate. Right, so on Tuesday, it will be he will be speaking there, and market's going to be paying attention. Market's going to be paying attention, going to be wanting to know what he says, and if he indicates that, hey, this jobs report was great, grand, and wonderful, and maybe we don't have to cut rates, market's going to sell off even more. But you think about his incentive. Fed Chair Powell, what's his incentive? His incentive is to drive markets higher. What's he going to say? Is he going to say, well, better than expected jobs report, so we're not going to cut rates? Probably not. In fact, he'll probably say just the opposite. So, something to keep an eye on there. And, while, yes, that fear and that tension in the market is palpable this morning, we can see that reverse very quickly early next week. Thanks for hopping on. Have yourselves a fantastic day. I'll be back on with you here this afternoon, and we'll talk to you then. Take care.